Hey, it's John Terry with Vision Advisors, and I wanted to make you aware of a recent IRS notice published early October 2022, issuing some guidance on required minimum distributions on inherited IRAs. Now, you might be saying at this point, John, what do you mean RMD relief on an inherited IRA? I didn't even know RMDs were a requirement. Well, welcome to the club, because there's a number of financial professionals just like you that may not have been aware there was an RMD requirement on an inherited IRA. Let me give you a little bit of a backstory and then explain to you what this notice actually does. Now, the problem for many financial professionals is this. Before the Secure Act, you and I, we all knew that an inherited IRA could be stretched over the life expectancy of a beneficiary. A younger individual inheriting an IRA from mom or dad or a grandma or a grandpa could literally stretch that IRA over years or decades, taking small RMDs based on their life expectancy and extending the power of tax deferral, sometimes generationally. That was a problem to the government, who needs more tax dollars. So along comes the Secure Act at the end of 2019. And one of the provisions of the Secure Act was this: a recipient of an inherited IRA, that beneficiary must fully draw down, they must fully liquidate that inherited IRA over a 10-year period of time. And this is the area many financial advisors missed it. They must also take RMDs in years 1 through 9 if the original account owner of that IRA or that retirement account died after that individual reached his or her required start date for their RMDs. So let me put that into plain English. If an individual that was a beneficiary received an IRA or inherited an IRA or inherited a 401k and rolled that over into their own name as an inherited account, if the original owner that established that account was already at the age they were required to take RMDs, then the beneficiary is also required under the Secure Act to also continue to take RMDs in years 1 through 9. Now, most financial professionals were aware of the 10-year rule, and you knew that you could take the money out 1/10 each year for 10 years or take it out every other year over 5 years. And there were different mathematical calculations you could use based upon the client's tax scenario and how they wanted to receive the money. You knew the account had to be distributed in 10 years. But many of you may not have known that if they didn't take a distribution from that IRA during that 10-year period, every year there was a minimum distribution requirement that had to be met. So that created a lot of confusion in the industry, because the rules surrounding these RMD distributions on an inherited IRA are not yet finalized by the Department of Treasury and the IRS. So that created a bunch of questions. When does a beneficiary actually have to start taking RMDs on an inherited IRA, or do they at all? If they're taking out 1/10 of a year, does that satisfy the RMD requirement? If they're not taking money out, do they have to take at least some to satisfy the RMD requirement? Do they have to do that now? Do they have to do that later? Those are the questions of the confusion, not just for the financial professionals, but for the tax professionals that are having to report this inherited IRA and any distributions that were coming from that. So along to the rescue comes the Internal Revenue Service, and they recently, in early October 2022, issued Notice 2022-53. This guidance clarified the rules around required minimum distributions and inherited IRAs. Essentially, it says we're going to give everybody a pass for 2021 and 2022. We're going to waive any penalties for failures to take an RMD from an inherited IRA over the past 2 years, tax year 2021, tax year 2022. This notice goes on to say, quote, regulations will apply no earlier than the 2023 distribution calendar year. So the IRS is giving notice that they're going to clarify the rules sometime in 2023. And we're likely to see these rules harmonize with a couple of pieces of legislation that Congress is currently deliberating and discussing right now. However, remember this: even though the RMD penalty has been waived, the 10-year distribution drawdown rule still applies. So what does this mean in plain English? An inherited IRA beneficiary still has to liquidate his or her inherited IRA within 10 years of receipt. However, if they didn't take an RMD in 2021 or 2022 or both, there is no tax penalty that's going to be assessed. We also know that the IRS is going to issue final guidance sometime in 2023. So that gives you and I and the clients we work with another year to engage in planning. Now, what's the key takeaway from this? Managing distributions in an inherited IRA is still important. Remember, tax professionals operate under an unwritten tax planning rule that says this: you want to pay taxes at the lowest rate possible so you can keep more of what you've earned. Important to remember in your mind, your clients, that anytime they take a distribution from an inherited IRA or any pre-tax account, that income is going to be included in the totality of that beneficiary's taxable income for any given tax year. And the more taxable money they make, the more money they're going to pay in taxes. So that's the key takeaway in understanding that that 10-year distribution rule still applies. And so working with your clients and their tax professional to find a way to take those distributions and minimize the amount of taxes paid to Uncle Sam is a prudent conversation to have. Now, as we wrap up this particular training, let me take a minute and point out a couple of things that are coming down the road that you probably want to be aware of as it relates to your clients. The EARN Act is now being considered by Congress. It's actually gotten through committee, and it's anticipated to be taken up sometime in 2023. This particular act, if it becomes law, would permit taxpayers with incomes below $100,000 to make catch-up contributions to either a pre-tax account or a post-tax account. Now, interestingly enough, the scuttlebutt from Congress says this: that Congress appears to be leaning towards modifying what they're looking at with the EARN Act so that the final version of the act that would go to the full Congress would lean towards after-tax catch-up contributions. They appear in this legislation to want to incentivize Roth IRA, Roth 401k, and Roth simple contributions. Well, the idea behind it is this: we take away the pre-tax opportunity so Congress can collect some taxes today. As a result of that, they're going to allow the individual contributing to these Roth accounts the opportunity to have more tax-free, tax-favored income as they get ready to retire. The other thing the EARN Act does is it encourages small businesses to adopt retirement plans. And it also makes it easier for part-time workers who want to participate in an employer-sponsored plan to be able to do so. And it's going to expand, in at least the current version that's being considered now, the Savers Credit for low to mid income workers. Now, you may ask, John, what's next? Here's what I can tell you. The Secure Act 2.0 is currently being deliberated in Congress right now. How do we go back and clarify and expand and add to what was done in the Secure Act to make sure that we have expanded the possibilities for individuals getting ready to go into retirement? Congress is beginning to realize that Americans are living longer than previous generations. Social Security, Medicare, our entitlement programs are in trouble. People that are leaning into these and expecting these to make up the preponderance of their retirement income, this is going to be a struggle because Congress is either going to have to raise taxes, they're going to have to delay the date of full access to those benefits. Modifications are coming. So looking for ways to incentivize workers and to incentivize Americans to do more to save, to create additional dollars for retirement is on the minds of our elected officials right now. So over the next several weeks and months, you and I, we all need to be paying attention to what's going on in Washington. Let our voices be heard and have input into how we as a nation and how our elected professionals can help you and I that work with our clients to help them create money solutions for retirement to have every available option still made available to them. So what's next? We don't know, but we're paying very close attention to what's coming. And as we get insight into what's going on there, we're going to keep you informed because that's part of what we do here at Vision Advisors every single day. We want to make sure that you are the knowledgeable financial professional that you need to be to help your clients make wise money choices so that the informed decisions they make are going to benefit them and their financial future is going to be sounder, stronger, and more in line with their goals and dreams than without you having input into helping them make those plans for the future. So that's what we do here at Vision every day to support you so you can support the clients and customers that you serve. Now, whatever you're working on right now, we'd love an opportunity to be engaged and to help you create a solution that serves your clients. How do we help you with that? You give us a call at Vision Advisors, 1-800-505-8489, and you speak to one of our business consultants and let us help you put together a plan that's going to help your clients achieve a goal or an objective or to alleviate a money problem that's got them anxious, worried, and concerned. By the way, you can also visit our website, visionadvisorsinc.com, a number of great tools and resources there to help you grow your practice. While you're on our website, visionadvisorsinc.com, in the upper right-hand corner, let me also encourage you to visit and like and follow our Facebook and LinkedIn pages, where we're sharing sales tips, sales ideas, and resource tools every day on social media. And be sure and visit our YouTube channel and go back and visit that often. And in fact, I encourage you to subscribe to our YouTube channel and click that little bell after you subscribe so you get notified every time we add a video. In our YouTube channel, you're going to find over 200 quality training videos on a variety of subjects to help you up-level your knowledge of the financial industry, to share with you marketing resources, sales ideas, and tools you can use to continue to serve your clients at an ever higher level. And we add to this YouTube channel on a weekly basis with videos just like this. We've got a vision for your financial success, and we're one of the few IMOs in the country that invests back in our producers, giving you an opportunity to use the same dollars twice to continue to grow and expand your marketing. Want to know more about that or the amazing tools and resources and marketing opportunities we have available to help you get in front of more qualified prospects and do so on favorable terms? Reach out to us at Vision Advisors, 1-800-505-8489, or check us out at visionadvisorsinc.com. I'm John Terry, Chief Marketing Officer for Vision Advisors. Thanks for joining me for this IRS update, Notice 2022-53. Have a great day.